Now let's compare the three different hedging strategies we have covered for foreign currency receivable. So forward hedge meant that we agreed to sell 100,000 pounds at the forward rate by taking a short position on a forward contract, and we locked in a guaranteed total dollar proceeds of $150,000. Money market hedge guaranteed us $143,888, and this is regardless of future exchange rate. Options hedge guaranteed a minimum of $134,250 from the sale of soybeans, but the proceeds, dollar proceeds, could actually be higher depending on the future spot rate. So when we compare these three numbers, obviously we can say that forward hedge is actually preferable to money market hedge, because we obviously want to receive higher guaranteed dollar proceeds, holding all else the same. So remember, these are dollar proceeds. These are dollars that we will be receiving, and we want to receive more dollars, again holding all else the same. So forward hedge gives us more dollars than money market hedge, so we can cross out money market hedge. So next, then we would compare forward hedge against options hedge, now that we have eliminated money market hedge. So when we do that, what we can do is we can solve for the break-even exchange rate that will make us indifferent between forward hedge and options hedge. So we will do that by setting the proceeds from these two hedging methods equal to each other. So obviously, if we do exercise options hedge, it will give us $134,250, which is less than forward hedge, but we may not. So we set the forward hedge proceeds of $150,000 equal to options hedge proceeds in the case when we do not exercise. So that is whatever the future spot rate happens to be, multiplied by 100,000 pounds minus the cost of the put options. And when we solve for that break-even exchange rate, we get $65.75. So what it means is that if in the future spot exchange rate in 1 year's time turns out to be greater than $1.6575, options hedge is preferred, as it will generate more than $150,000. But remember, at least always $134,250. But if in the future spot exchange rate happened to be $1.6575, options hedge and forward hedge will both give us dollar proceeds of $150,000, so we are really indifferent between the two. But if in the future spot rate happens to fall below this break-even exchange rate number, forward hedge will be preferred because it will generate dollar proceeds of $150,000, while options hedge will generate less than $150,000, but remember, of course, more than $134,250. So what it means is whether we go with forward or options hedge really depends on our expectation of the future exchange rate. So if we believe that in the future spot rate is likely to be lower than this number, then we will probably prefer forward hedge. But if we believe that in the future spot rate is likely to be higher than this break-even exchange rate, we will most likely prefer options hedge. But remember, money market hedge was eliminated because it was inferior to forward hedge. It gave us actually less dollar proceeds than the forward hedge.